Hi everyone, I'm Paul and welcome to my review of Lesson 4 of ICT's 2022 Mentorship Program. I've been getting a heap of comments and likes and subscribes on this series of videos. It's really encouraging and I really appreciate it, so thank you to everyone out there. And let's jump into today's video. So today's video is a review of Lesson 4. It's just a short one today. We're just reviewing two trades that ICT went through in the video. And those two trades are bearish market structure shifts. The first part of the video is a review of an S&P trade from the 26th of January 2022, and that's on the 4-minute chart. And the second part of the video is a review of a NASDAQ trade from the 27th of January 2022 on the 5-minute chart. And I'll be going into quite a lot of detail on the setups and then the exits on both of those trades. So we'll start first with the S&P trade from the 26th of January. So what I've done with this particular chart, this is the 4-minute chart, is I've used a fib to mark out the low to the high and the range. And so this shows us very clearly that premium zone and the discount zone. So just keep in mind when you're looking for these setups, you're looking to sell in a premium zone and buy in a discount zone. And obviously vice versa, if you're looking at going long, you'd be buying in the discount zone and looking to sell in the premium zone. So in this case, the market opened low and started to trade higher into the session, and you can see we created these new highs here. And actually what I've done is gone back and marked out a high from about 2 sessions ago. So I've also found with a lot of these setups it is helpful sometimes to be aware or mark up the highs and lows from not just the session before, but from the session before that as well sometimes, because when the market moves outside the boundaries of the previous session, it's not uncommon for those previous highs or lows to be run on a previous session as well before you have that run up into that area of interest or that liquidity zone. And so that's what happened here. We had a run up into highs, but we also breached the highs of about 2 sessions ago. And we had this run up into this liquidity zone here, creating this area of interest for us. So if we zoom in a little bit closer, we can see this area of interest in a bit more detail. And you can see I've marked out the fair value gap here with these blue lines. So this is the fair value gap here, and this is where our stop would be. So if we run through our checklist, and we can use this to make sure that we have all the elements required for that bearish market structure shift so we can go short. And so the first one is, do we have a push higher or a stop hunt into liquidity, taking out those buy stops? And so yes, we do. So remember from the previous videos, we've talked about these previous highs here is where retail traders will look as resistance. So they will be going short from these levels and naturally have their stops residing above these levels, and they'll be buy stops obviously to protect those short positions. So we have that run up into these liquidity zones. So that's the first point in our checklist. The second is do we have a swing low candle pattern? And remember from the other videos is that swing low pattern is the middle candle has the lowest low, and then the 2 candles beside it have lows which are lower than that point. So that creates that swing low pattern, which we have, right here. So that's here, I'll mark that up. We have that swing low pattern there. So we have that in this particular setup. So the next point is, do we have a break of the low from the swing low? And so yes, we do. You can see these series of candles here, and in particular the second candle in that fair value gap setup is the one that breaks the low of the swing low. So this low here breaks the low there and creates a new lower low. And so our fourth requirement is, do we have a fair value gap setup? And again, yes, we do. So we have that 3 candle setup that we're always looking for. So we have our first candle, the second candle, and then the third candle. And the fair value gap resides between the low of the first candle, the high of the third candle, across the body of that second candle. So you can see our fair value gap is formed there, and I've marked that with these 2 blue lines there. Now, keep in mind that if we're looking to enter the position or enter that fair value gap on a trade, we'd either put our sell order here at the high of the third candle and our stop at the high of the first candle. You can use the second candle, but in my experience, you always want to use the highest one, so we would use the first candle in this instance. The other option is you can enter via a market order, so you can just go short as soon as the market trades back into that fair value gap, and then posthumously set your stop at the high of that first candle. And then obviously what we need is one of the subsequent candles to trade into that fair value gap to complete our setup and our change in market structure, which we have. So that happens here on this candle. You can see it trades quite clearly into that zone, and that allows us to get set to the short side and take advantage of this bearish market structure shift. So we're in the trade now, and so how do we manage the exit, and how do we make sure that we're going to capitalize on as much of this move as we can? So what I've done is I've set up the sell tool here, and you can see if we lay that across the setup here, we just set it across our stop, and we can have a look at what kind of return we could potentially have got from this particular setup. So if we go to the maximum of the down range, you can see the maximum we would have gotten out of this particular trade is an R of about 3.5. So that's really good, and that's obviously happened in quite a short time frame. So we're on a 4-minute chart, and that's happened in 1, 2, 3, 4, 5, 6, 7 candles. So that's happened in about 30 minutes. So that's a pretty good return for a short time frame. Now you've got to remember, ICT always talks about we're just going after the low-hanging fruit in this trade, and because we're talking about a bearish market structure shift on an intraday time frame, we're not talking about a market structure shift on a higher time frame. So this is only going to be a transient change in market structure. It's not going to last for very long, and so we need to make sure we take advantage of it and then get out. And so you can see that in this example, after the market trades down back into this discount zone, it immediately trades back up, and you can see later we actually would have been stopped out if we'd stayed in the trade for too long. So when we have this bearish market structure shift, it's immediately going to start hunting for sell stops, which will reside below the lows, and it's also going to start looking for bullish imbalances or bullish fair value gaps on the way down. But again, this isn't going to last forever. So if we look at this particular setup, the natural places you'd look at is obviously this first set of lows here, which is where you would have, again, sell stops residing. So if we pull this back to here, we can see if we'd gotten out here, that would have been 2.4R return. So again, pretty good. And again, that would have only happened in about 3 or 4 candles. So, you're in that trade for about 15 minutes and you're getting a 2.4R return, which is really good. If you look to the left, you can see we have this bullish imbalance just here. So again, if we'd allow the market to trade into that zone and then use that as one of our exit points, you can see that would have happened, say, on this candle here. We would have almost got a 3R return on that as well. So again, that's a really good return for only 15-20 minutes worth of being in a trade. That's a very short exposure. The second trade we're looking at is a NASDAQ trade from the 27th. Now, this particular setup's residing on the 5-minute chart, so the last one was on the 4-minute chart, this one's on the 5. So just remember, when we're looking for these fair value gap setups and these changes in market structure or these market structure shifts, we can be looking at anything from the 1 to the 5-minute time frame. So in this setup, similar to before, the market's opened at the lows and then traded higher, and I've run this 50-50 fib across that range from the low to the high to show this premium and discount zone. So again, in this example, we're looking at going short, so we want to be selling in that premium zone, and we obviously want to be trying to close out, if possible, down in this discount zone. And again, if we were going long, we'd want to enter that long position in this discount zone and ideally be exiting out in the premium zone to be getting the maximum return from that trade. So in this trade, you can see the market opens at the lows and trades higher, and then it trades through these lows from the previous session just here and pushes higher, and this is where our setup occurs. So running through our checklist again, we can make sure that we've got all the requirements we need to enter a short trade on a bearish market structure shift. So our first point is, do we have a push higher or a stop hunt into liquidity, into buy stops? And yes, we do. We have this push through these previous highs up into this zone here, this stop hunt into liquidity, looking for those buy stops. Now, second point is, do we have a swing low candle pattern? And again, yes, we do. You can see this candle here is the lowest in the 3 candle pattern. So we have this pattern just here. So you can see we have this candle is the low, and then the 2 candles each side are lower than that low. So that creates our swing low pattern. Do we have a break of the low of the swing low? And again, yes, we do. We can see we have our fair value gap pattern here, our 3 candle pattern. and it's actually on the third candle this time that breaks the low of the swing low. So you can see this candle here trades past the low of the swing low. So remember, it just needs to trade past it. It doesn't have to close. So as long as the wick of this candle is lower than the swing low, then that meets the requirements. So you can see this candle does that. It trades lower. We now have a lower low from this swing low. And then our fourth point is, do we have a fair value gap created? And again, yes, we do. We have our 3 candle pattern. So 1, 2, 3. And we have our fair value gap formed between the low of the first candle and the high of the third candle. So you can see this is quite a small fair value gap in this example. And again, as before, we would have the stop at the high of the first candle. Then to get into this trade, we obviously need the market to trade back into that fair value gap. And so we have that happen a few candles after the fair value gap's formed. So you can see the market trades lower. It actually trades lower than all of these lows. And then it comes back into that fair value gap. It actually comes in quite a few times, so there's quite a few opportunities to get set in this example. You can have your sell order all keyed in and set at the high of this third candle with your stop at the first candle, or you could just be waiting until the market trades back into that zone, trade at market, obviously short, and then posthumously put your stop in afterwards to protect yourself in this position. So we've met all the requirements for our bearish market structure shift, and we're now short in this trade. So how do we make sure we get as much out of this trade as we can? So we'll just step through some of the possible scenarios with this particular setup. So remember, we're in a short position, we have a bearish market structure shift, and price is going to be seeking sell stops below the lows, and it's also going to be looking for bullish imbalances or bullish fair value gaps on the way down. So if we mark up this trade, you can see we would have got into it around here. And our first area of interest is going to be this cluster of lows here. So this would obviously be pretty soon after our entry. So we'd obviously want to be in the trade for a little bit longer than this normally, because we're still also in this premium zone. We haven't traded into the discount zone yet. But if we just mark this up and just see what we would have got, you know, if we traded down to these lows here, that's still a 2R return. So that's still not too bad. And obviously, depending on which one of these candles we got into, you know, we would have been in that trade for probably anywhere between about, say, half an hour to about 15 minutes. So that's not too bad. The next likely place we could look at would be the lows either here or here. And you can see we've also got a fair value gap down here, which we could have targeted as well. So if we run to the lows down here, you can see we're at about a 2.4R return. If we run down into that fair value gap, we're at about a 2.8R return. So again, that's quite good. If we ran to the lows here, you can see we're hitting that sort of almost 3.5R return, which is quite good. Now in this example, the market trades all the way down to here. It doesn't really get too much lower than that. And you can see we have another fair value gap down here on the left, which could also be another target. So if we pull our sell down into this and we can see what kind of return we would have got, you can see we're now getting to over a 4R return, which is quite good. So in this case, the maximum return we would have been able to get on this trade was about down here, and that's over a 5R return. So that's, you know, a really fantastic return for, again, a trade that we're not in for, you know, more than maybe an hour and a half or 2 hours. So there you go. There's my review of Lesson 3 of ICT's 2022 Mentorship Program and the 2 trades that he covered in that particular episode. Just of interest, I've been doing a lot of testing on this with Bitcoin. As you know, if you've watched any of my previous videos, I'm really focusing on cryptocurrencies in terms of applying ICT's lessons to that. And what I've discovered so far is that the setup that I'm working on, which is using exchange time, is I'm on average getting about a 3R return or better. And so that's quite good, and I'll hopefully be sharing a little bit more about that day trading strategy I've been building and testing as I work through it. So it's not quite ready, but it's going to be coming soon, so something to look forward to. Thanks for watching. Please like and subscribe if you've enjoyed this video. That'll help other people to find it, and I'll see you in the next video.